Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel L. Connon, along with Brent Slava, and we have David Tawil on the line. He's the co-founder of Maglan Capital. David, how you doing today?
Good morning, Joel. Doing great.
And so what do you think about our Wolverines here, having a little bit better season? You getting a little bit excited?
I am. I don't know if you know, I'm a Michigan alum as well. I went to law school there.
And you made it in for any games this year?
Oh, no. Wife and 3 kids and one on the way doesn't make that so easy.
Okay, so you're kind of in a fast market over there. Well, I'm going to Bloomington this weekend for the Michigan-Indiana game, and then looking forward to that Michigan-Ohio State game. So hopefully can Harbaugh keep things on a roll here. But let's get to the market here. And, we're having some macro trends develop here. We've had some volatility and kind of fragmented markets here. What are you focusing on?
So it's an interesting market, not to overuse the term, but, we've got a lot of volatility, a fair amount of fragility in the market. People are concerned about the Fed interest rate hike. And so depending on where sentiment coalesces and when the Fed moves, I think a lot of people are just waiting on the sidelines right now and not really putting a lot of capital to work. We saw in August and in September a really harsh sell-off in the high-yield bond market because of the amazing amount of volatility. As that volatility subsided into October, there was a big rush in momentum in mega cap names. I think as things settle down, some of the more value-driven equity names will get some good attention and hopefully will move up as well. And then, if the Fed does raise rates, there may be a considerable sell-off in high yield, and some of the more stressed sectors, in particular, and this is nothing, amazingly new, but energy, metals, mining, can really, really sell off even harder, frankly, into the new year if the Fed moves in December.
Okay, and you mentioned, some of the, after the dust settles here, some issues that, may come back into favor. Just kind of like your old standby stocks. What are some of the issues that you're talking about?
So we primarily focus on small to mid-cap names. So they're not particularly well-known names. So, for instance, in the telecom space, the most well-known names in wireline telecom are the very large leveraged names like CenturyLink, Windstream, Frontier. We're actually very heavily invested in a company called Fairpoint Communications, which is quite smaller, although it's the 5th largest telecom in the United States. Nevertheless, it's quite small in comparison to its peers. It's been able to do things both on the expense side and on the revenue side that its peers haven't been able to do. They've been, working an operational turnaround over the last couple of years. They still don't trade in line with their peers. One reason is they don't issue an equity dividend. That may change at some point, but maybe in advance of that, frankly, the company could be sold. Management is looking at strategic options. They've, pronounced that on a couple of occasions. And so I think, as markets kind of settle down and the largest names in the market kind of trade up to fair value, value investors go ahead and move a little bit down the line into mid to small cap names and are able to go ahead and kind of lift the values there.
What's the symbol on What's the symbol
right now.
What's the symbol on that one?
Oh, I'm sorry. F as in Frank, R as in Roger, P as in Peter.
Okay. All right. Let's take
It's had a pretty good year in comparison to, the other telecom names. It's up about 19.5% year to date, while, its peers are down anywhere between, very high 20s%, to as far as 50% on Windstream.
What areas of the country do they focus on?
Geographically, they're primarily focused in Maine, New Hampshire, and Vermont. They actually have an exclusive footprint up there in 3 contiguous states. They've been able to execute, like I said earlier, on an operational turnaround. And earlier this year, in February, they struck a new union deal with their 2 labor forces that make up the majority of their headcount.
All right. Now, so one of your favorite positions currently is an energy company. And Matalita Energy, I mean, come on, this is just one beat up sector here. What are you seeing in MDLNF?
Okay, so this is a company that is based in Canada for corporate purposes, but has all of its operations down in Argentina. So this is a good example of situations that we try to find. They're pretty one-off in terms of a baby being thrown out with the bathwater. So your reaction is correct. General reaction, energy, got to stay away from it. It's got to be, plagued. Who knows where the bottom is on the commodity on the open market. However, in Argentina, little to many people's knowledge, the price of oil and gas is fixed by the government. And currently, and it has been for some time now, fixed at $75 a barrel. Yes, let me say that again. $75 a barrel is what this company and all of its peers get paid for oil, even though we see on the open market, we're at $42 today on WTI and $45 on Brent. And so therefore, this company is able to go ahead and rely on that top line and continue to go ahead and grow. Couple that with the fact that they have the second largest shale deposit in the world for gas and the fourth largest shale deposit in the world for oil down in Argentina. And this company is in the process of growing its conventional production and, in addition, tapping into the shale. And we're poised right now, a little bit of macro for you for a second. Argentina has been in default on its debt for the last 13 years. The country is currently going through an election that is going to bring a change in regime. Both current presidential candidates are, signaling that there's going to be a resolution of that default. If that happens, the country will go online in the world banking markets for the first time in 13 years, and the outside world will be comfortable in investing in that country. So we've got amazing fundamentals for the company. We've got a very good management team. We've actually gone activist on the company. We've appointed a couple of board directors, including the chairman to that board. The company is operating without any leverage. That's an anomaly in the energy sector. They're generating free cash flow. They're putting that back into the ground in terms of CapEx, and we've got a macro environment in Argentina that is about to get much better after the election.
And penny stock here, a lot of times once they go under $1, they never come back. Here's just kind of wallowing at a quarter here. You're not worried about this company going under?
Oh, no. There's no reason for the company to go under. I mean, they don't have any leverage concerns. Like I said, they're generating free cash flow. So, no, this is a growing company. Frankly, in Canada, there are a lot of penny stocks. It's actually not as rare as it is here. A lot of, I would say, healthy companies trade at pennies up in Canada.
How can the Argentinian government, I mean, how could they get themselves into that situation where they're actually, paying 33, I mean, they got to be going out of business. I mean, I want to short everything in Argentina when you tell me that they're locked in at US dollars, $75 a barrel. How long is that going to persist?
So that'll actually persist for some time, and I'll tell you, it's pretty good policy. Let me explain some of the factors surrounding the policy. First of all, it costs them a lot to get energy from outside of their country. They are not encouraging domestic production for purposes of export. They need it for purposes of consumption. They actually have to import over 50% of their energy needs. They pay Peru $14 per million BTU for gas. In contrast, here, natural gas on the open market trades around $2, right? So they actually have pretty high costs on their lowest cost provider outside of the country. The country wants to get to a point of energy independence. I actually believe that that's a very good policy generally. That's first of all. Second of all, they're only encouraging this for a period of time until such time as they reach energy independence. So frankly, it is a good policy for a medium-term period of time until such time as the country reaches independence. That won't happen for a number of years, but nevertheless, based on how much it would cost them to go ahead and import, plus the policy of reaching energy independence, those two coupled together, get them to a point where it makes sense for them to pay up a little bit for the oil and gas based on what the general open market pricing is for it.
All right, just a quick update. S&P futures falling out of bed here, down 12 points, 56.75. We are looking for reasons for the soft. We're going to bring in the Brentster real quick here, David. Get a market update.
Hey, so we did have some comments coming out of the Fed's Bullard. He is not really saying a ton. However, one comment which the street might not be liking is he said that the U.S. could be possibly entering an era of, quote, permanently lower inflation and interest rates. Everything else looks as normal. He said he still prefers that the Fed start raising rates sooner rather than later. Nothing really else too exciting there except for that one comment.
Boy, is he brilliant or what? What do you think about those comments, David?
I think that's dancing.
Yeah.
But that's good. That's okay.
Dancing's good.
All right. We talked about some of the issues that you like, and you're trying to avoid the crowded trades and the public battleground situations here. Let's talk about some of those stocks and why you're staying out of them.
Okay. So, like I said much earlier in the conversation, we're dealing with a fair amount of volatility and fragility in the marketplace, especially in equities, and especially in situations that are, pretty high-profile battlegrounds, and they seem to be, popping up daily with short sellers and activist long sellers on either side of trades. And frankly, you could be very right on either one or the other side of those trades, but because there's so much battleground situations, frankly, the near and medium-term movement may not give you the ability or may take you out of the ability to stay in those trades for a long period of time. So, frankly, the fundamentals, in some sense, for those investments don't really matter. So things like Valiant or Sun Edison or Maglan Capital, those are big situations that we've seen of late, but there have been smaller ones like a Straight Path, so to say, where, frankly, it's an immense amount of, vocal activism on both sides of those investments, and it just doesn't pay. You really have to have, a long-term focus and the ability to stay in those investments for a very long period of time, potentially, until such time as you emerge victorious.
Yeah, I have actually kind of getting creamed in one of those trades, just kind of looking for a technical bounce. But when the momentum, turns, and you're right, that moving on the headlines and stuff, it's impossible to react. The move in Valiant here, just unbelievable. Come down from $260, and it doesn't seem to be any bottom in sight. So you're not tempted to go with these trades. You're just like, this is a mess, and you try and stay out of it, and that's the best course of that you pursue.
We see ourselves primarily as investors, a longer-term focused, about 2 to 3 years in our investments generally, not traders. And even though we take a long-term focus, frankly, I don't like to get beat up too much, similar to the next guy, on a month-to-month basis. So, Herbalife, Nu Skin, Volkswagen, Iconics, Flowtech. The list really goes, Community Health. The list goes on and on. The number of sectors that folks are trying to avoid right now is just immense. It's really unbelievable. It leaves you with very few sectors. After Macy's reporting yesterday, people are thinking, well, should I avoid retail, going into the holiday season? Because, I have no idea, the weather, the e-tailing, Amazon effect, and so on. It's just, there are a number of situations, at least on an investor basis, on a long-term basis, that folks are, thinking, well, should I wait until the dust settles here before I go ahead and invest, even if I have particular issues that I like? Nevertheless, there's so much battle going on right now, so much up in the air, and the gap's down. I mean, Macy's gapping down 14% yesterday. I mean, that's a huge move. What happened to Iconics earlier in the week? I mean, gigantic. So, I just think that for the longer-term investor as opposed to the trader, this isn't, particularly the greatest environment to go ahead and barrel in unless you're expecting to be there for an extremely long period of time. And frankly, you don't care on any level what the interim volatility looks like.
Okay, and just to get your comments here on the financials, just overall. I mean, interest rates supposedly are going up. This while the market was getting creamed on Friday, a lot of these financials showed a lot of strength. Are you a believer in that? I mean, if the whole market turns around and goes south, can the financials, just because rates are going to go up a quarter point? I mean, is that, do you think there's any reason people should be flocking into the financials?
I think the financials have been ignored for so long that this is their dead cat bounce. But I agree with you on kind of the more fundamental point, which is if the economy isn't doing well, a quarter point is really not all that much. At the end of the day, is this going to be that accretive to the business that they're doing? I mean, all that accretion from the quarter point may be offset by how crappy the economy is. And so therefore they may be left flat at the end of the day, maybe a wash. And so therefore there's no reason to go ahead and chase. And frankly, who knows when the next rate lift after that first quarter point is, because the Fed has said, we're going to take it really slow and really easy. So maybe it's not. But like I said, maybe this is their dead cat bounce after being offline for so many years.
We've been on the line with David Tawil of Maglan Capital, joining us, giving us what he likes and what he doesn't like. David, thanks for coming on. We'll talk to you again soon.
Always a pleasure, Joel. Take care.
All right.